The first company speaking tonight, or fund speaking tonight, is Gresham House Energy Storage Fund. Now, Gresham House itself is a very long-established investment house going back to 1857 and has, in recent years, specialised in alternative assets. Now, Gresham House Energy Storage Fund, which amazingly managed to get the mnemonic of GRID, was brought to the market in November last year, raised about £100 million. Its target, when fully invested, is a dividend of 7p, which equates to, at the issue price, a 7% yield. Ben Guest is the head of the new energy team at Gresham House. Has got a long experience in this sector, something over 20 years experience. Has got quite a big team helping him on this, and has a particular interest in energy storage technology and its use in renewables and electric vehicles. So Ben, over to you.
Thank you very much to Keith and to Hardman for welcoming us this evening. So we listed this fund in November of last year, and I'll spend a couple of seconds on Gresham House. As Keith rightly said, it's a long-established company. It was re-established as an investment trust in the 60s. It was in runoff in the earlier part of this decade and was reinvented via a management buy-in spearheaded by our CEO, Anthony Dalwood, in 2014, and has been reinvented as a specialist asset management business. And through acquisition and organic growth being an example of this being that, it has grown to £2.3 billion from what you could call a standing start in 2014, late 2014. I don't have enough time to go into any more detail, and I prefer to focus on the fund. So what am I talking to you about today? Energy storage is essential infrastructure to enable the installation and generation of substantial amounts of renewable energy on the grid without waste or exceptional cost. Today, we're at 33% renewables on the grid as of last quarter, and that's growing very quickly and will approach 50% in the fairly near future. For that, you need energy storage or other forms of what are more broadly called flexible generation, of which we think battery storage is the most compelling, to make it happen. And I'll elaborate in a moment. So what is this as a financial investment? Well, we're an LSE-listed closed-end fund investing in a portfolio of these battery projects, and I'll tell you what a battery project is in a moment. We've raised exactly £100 million so far, and the team is actually pretty heavily invested across the team. We have in the region of £15 million invested in this fund. We're targeting a 7p yield, which is a function of the underlying profitability of the projects, but we're also targeting substantial capital growth. We expect to reinvest some capital into the business, and some of the capital growth we believe will come from really manifestations of what we've seen in so many other areas of infrastructure. Today, the discount rates used to acquire these projects are 12%. We expect these to come down as people get more familiar with these projects and this industry, and are prepared to invest in them at lower rates of return, which we hope, of course, will drive the share price, which is actually one of the major rationales for a listed vehicle. So what have we done so far? We've invested in initial projects that we developed and built out over the last couple of years straight away. So we invested £60 million in total, including the fundraising costs from the get-go, into a 70-megawatt portfolio. And we're not standing still. We're running at building out our portfolio. We've got 5 megawatts, which is quite small, in construction right now, and expect to build approximately 130 megawatts, subject to further fundraising later this year. One really interesting feature of this is that returns aren't correlated to the absolute level of power prices. So if you're worried about where power prices are going, you don't have to worry about that in the context of this fund. We're really playing the volatility in power prices, which is going to increase as a function of renewables. It's a really crucial point. Another important thing is that this is a merchant business model. We don't apologize for that. A lot of people don't like that, but we think it's an extremely compelling one, and we're not therefore requiring subsidies to make the business model work. I think that's quite important because it means that the backdrop for this market is entirely commercial and therefore doesn't cost the consumer anything. In fact, it saves money for reasons I can explain in Q&A if there's time. Ourselves as managers, I've been in this industry for over 10 years. We've got an extensive team of 16 people, and we're, we've all been doing this for a long time at all sorts of different levels, from development to fund management to actual technical expertise. So this is just a list of the projects. These are the ones we've acquired so far, and simple descriptions of them. These are the projects that we're looking to build out. This is the ones in construction. This is the one comes next, and these ones are definitely foreseen for this year. Again, subject to some fundraising, but we're pretty confident. And then this is another one that will come probably early next year. So clearly, from a starting point of 70 megawatts, we're looking to grow this very substantially. Let me give you a bit of a comment, though. The installed capacity of renewable energy today in the UK is about 43,000 megawatts. So it's grown from virtually 0 to 43,000 megawatts in about 10 years. In fact, less than that. Here we're talking about piddly sort of hundreds of megawatts of energy storage. This industry is going to be mirroring the sort of size of the renewable energy industry in terms of installed capacity. And whether it's batteries that do it, or gas peakers, or interconnected with other countries, the combination will need to mirror roughly the size of the energy generated by renewables because of renewables intermittency. They can be on or off. And so when they're off, you need something to replace them. When they're generating too much, you need to store it, or you waste it. And right now, National Grid is paying approaching £200 million every year to ask wind turbines to switch themselves off, and when you're in a valley, to get gas peakers to expensively turn themselves on. It's a very inefficient system at the moment. These are some pictures of what they look like. Gives you an idea. They're extremely efficient in space, actually. A large site can occupy between 1 and 2 acres. That compares to dozens or even hundreds of acres for renewable projects. They're actually very, very compact. So what's the backdrop to this? Obviously, the UK government, the legislation for this is the Climate Change Act of 2008, which sets the target of an 80% reduction in CO2 emissions by 2050, with intermediate targets set by the government along the way. What's exciting is that so far, we're on track to meet the first 3 targets comfortably. The government's finding it much more difficult, and the Climate Change Committee for Climate Change, the CCC, is saying, actually, we're starting to run out of steam. There's a lot that needs to happen, and the 3 key areas are electricity, where most of the running's been done. The other 2 key areas are petrol consumption. Moving to electric will obviously help that. Heat consumption in the form of gas. Electrification of heat is the main source there. That's really for backdrop. It's not that relevant here. So this is the steady trend I was telling you about. We've hit 33%. This is effectively biomass. This is wind, onshore and offshore. And this is what's going to do most of the running going forwards. We've got gigawatts of offshore wind, which continue to be subsidised, being installed over the next 10 years. The government reinforced that recently. And the level of subsidies is now so low that it's possible that the government actually make money out of this, because it's structured as a contract for difference. In other words, if the agreed price between the government and the project owner is higher, lower than the actual outturn power price, the government actually makes money. It's a CFD. So it's entirely possible that this is actually not a very big cost. But creating that structure makes them very bankable and guarantees their deployment over the next 10 years. As a result of that, we're going to go from this 33% towards 50%, probably within the next 5 years. And that's when it gets very interesting. Why does it get very interesting? So I'm going to pause here, because there's actually something you can probably study in your own time later, but this is the crux of it. What makes this an interesting area to invest commercially? Well, the simple fact is that you have 2 things going on. You have a range of different technologies that generate power at a range of different costs. And interestingly, it's not a small range. It's a very large range. And that creates the potential for very low and very high power prices. And the second thing that's going on is that you're seeing daily fluctuations in demand, not quite 2 to 1, but here you have 27 gigawatts as a typical trough in the night. Here you have 47 gigawatts as a typical peak in the daytime in the winter months anyway. It's a bit lower during the summer months. And therefore, in an environment where you have a lot of renewable capacity, the marginal technology that meets the demand is gas here. And that's quite a cheap technology. So the power price will be quite low at night. Here, it's high demand, and we've made an assumption that there's limited solar and wind. This happens all the time, so it's not a sort of crazy assumption. So here you have high wind, no solar because we're in the middle of the night, and that's when demand is low. And here you have low renewables in general because that's just an assumption I've made, which is a frequent assumption, and I'll show that in a minute. Here, peaking plants are having to meet the marginal demand. Power prices can go very high. Now, this is describing a very orderly situation. In reality, National Grid is trying to balance the market in half-hourly periods with output varying and being uncertain. Therefore, these are sort of the sensible ranges of about zero short-run marginal cost to over £100 short-run marginal cost. But the reality is that you can go substantially negative or well above that. In your minds, if you don't mind, fast forward to a world where, so this is going to be a constant. This is pretty much what we're going to keep seeing. Peaking plant meeting the marginal demand when demand is high. But imagine a world fairly soon where you have much more renewable power. This wind will move up. Biomass will move up. Sometimes it will happen in the day, some solar. What will then start to happen is that gas isn't meeting the marginal demand. It's coal, but coal's coming off by 2025 because that's legislated to happen. So it's going to be maybe met by nuclear. But what if this combination of technologies are all generating 100% of what we need, or let's say 105%? Nuclear won't switch itself off because they don't. They're technically very difficult to turn down very quickly. Renewables, well, they're incentivized. They're going to get paid whether they earn a zero power price or a very high power price because they're getting their generation tariff. So what happens then is that they need to be paid by National Grid to turn down. And so you end up with really bizarre situations where power prices can go substantially negative. This is already starting to happen. It's mostly happening not every day, which is what this is trying to illustrate, but on weekends where it's very sunny, very windy or blustery, and demand is very low. So you end up with situations where you can have very high power prices and very low power prices. Now let me tell you, this is the real world today. These are five minute by minute increments of solar, wind, biomass, and nuclear generation since 2011. So a bit of a choppy chart. It's quite a few megabytes as well. And what you see here is that you see the intermittency of renewables here embedded in this chart. And that leads to situations where increasingly you're getting up towards the very upper bands of all power being met by renewables. And these bulges here, by the way, are the summer months where solar is generating during the daytime and causing problems when they're approaching 100% of total generation, because you've then got to ask all gas to switch off for a few minutes. It gets very expensive. And at the other end, despite there being 43,000 megawatts of them, they can be generating virtually zero. Let's not forget that 20% of this figure is nuclear. So actually, in these instances, renewables are generating next to nothing. So you've got this enormous range, and therefore the fact that you can have low demand and high generation, or high demand and very low generation, leads to this potential volatility. And this is the profit pool that we're talking about from a merchant perspective.
Sorry, just a detail, the y-axis is still here. I've got it peaking out at less than 70% on the credit version.
Okay, in that case, we've got slightly different charts here. One won't include nuclear. I'm curious as to why that happened.
Do we have the right level up there?
We do, yeah, because this includes nuclear. So with nuclear, it gets to 100%.
Okay.
Okay, sorry about that. I'm not sure why we've ended up with different charts. Does everyone have 70% on that chart? Anyway, let's move on. To the points I was making, so far we've only got a very little amount of flexible generation. Batteries are only 500 megawatts. We've got other forms of flexible generation which can help support the grid in forms of interconnectors with France, Ireland, the Netherlands, and others are contemplated, but they don't perform very efficiently because they're really running their own business model. They don't really care about balancing supply and demand in real time. And then you've got some gas peakers. But gas peakers only deal with situations where there's peak demand. They don't actually help get power off the grid when when there's excess generation. So you need something for that, and batteries do that very well. But in any case, this speaks to the general need of what this market's going to be. And this is not our forecast, this is a third-party forecast of how big this market will be. Now, this might sound fantastical, but actually this rate of growth is very similar to what we've seen in renewables. In fact, it's slower. This speaks to 36-odd gigawatts in 2030. In a far shorter period of time, we got to the over 40 gigawatts of generation of renewables in the UK.
Ben, you've got about another 3 minutes.
Okay, I think we're getting there. Batteries getting cheaper, therefore the projects are getting more profitable. More volatile, cheaper projects, expanding IRRs. Don't need to say any more than that. And then how do we position ourselves? Do we put ourselves behind the meter, as they call it, on someone else's premises? Do we co-locate, another expression in industry, with wind or solar projects? Again, something else that you could do. Actually, what we think is most profitable is to build your own project connected to your own grid connection on the grid to really capture the extremes which manifest themselves in the wholesale power markets, not being tied to another owner of an asset type. I can go into more detail on that. So our revenues, effectively trading, what we call asset optimization. Here you're capturing the peaks and troughs of the day, or you can make your asset available for something called frequency response. Second by second, National Grid needs to maintain the frequency on the grid at 50 hertz. You can provide that very well with batteries. Those are the alternative revenue models. The amount of demand for this is limited, frequency response. It's about a gigawatt market of demand. The opportunity in asset optimization, as I expressed earlier, it's in excess of 30 gigawatts in terms of potential demand. So this is going to be the mainstay market. These are more smaller levels of revenue, so I won't go into the details. And so we expect over 70% of our revenues to come from trading, what I've mostly been describing in my presentation. But frequency response is a lucrative market, which you can do at times of day when you know that frequency asset optimization or trading is not so profitable. I won't go into this detail. This is where we say we're very cost-focused and we have a very good team in terms of the level of expertise that we've got, but don't have the time to discuss it in detail. So in conclusion, essential infrastructure, supporting the government to meet its long-term energy transition targets. Batteries, we think, are the winning technology over gas peakers or interconnectors or anything else. And then the attraction of these investments is not just a nice return, very high EBITDA margins, but just the asset backing as well, without the need for subsidies. I'll pause there. Thank you very much. I hope that was interesting. Can I stay here? Yeah.
Yes, we'll take some questions now. Donald is there with a microphone, so if you put your hand up, Donald will come to you. So who'd like to ask the first question? Let me ask the first question then. So let's talk about the risk in the capital cost of build and the data that there is about the lifespan of the batteries, how reliable that might be.
So the cost to build these projects is coming down all the time, mainly as EPC contractors, the contractors that build these projects, get more accustomed to them as we build them at bigger scale. Leading to greater potential to do things. And actually batteries have got so cheap now that the auxiliary equipment is actually the majority of the cost, whether it's the concrete or the inverters and transformers and, dare I say, fencing and all sorts of other things. The batteries are now only a quarter of the cost of the project. What was the second question?
The longevity.
The longevity of the batteries.
Guarantee around that.
Well, there are warranties on our batteries, warranties on cycle life, so long as you use them in a prescribed way, that you agree with the battery manufacturer. So there are standard terms in the battery industry around cycle life, around the rate of degradation and therefore capacity relative to the beginning of life capacity and so on. And you can model that in great detail actually nowadays, in the same way that you can for electric cars. Lithium-ion technology, which is what we use, has been around since 1991. And in large scale for cars or battery storage for at least 10 years now. So it's actually surprisingly mature technology, and it's a breeze to maintain compared to mechanical equipment.
Okay, thank you for that.
I was going to ask a bit more about the technology because I think the proposition that And the problem with renewables for years has been that you generate renewable energy, but it's where you don't want it, when you don't want it.
Yeah.
So batteries, clearly, the opportunity to store is very, very attractive.
Right.
But I'm intrigued about the technology. Just touching on that.
Yeah.
Are you using one technology or multiple technologies? Because I just wonder whether or not the technology for batteries is necessarily reached the point that it's its end point in terms of development.
It certainly hasn't reached its end point. That being said, the rate of progress in the battery industry is famously slow. Batteries have a set of characteristics. They obviously have a cost, they have a cycle life, they have a rate of degradation, they have a peak power capability, they have a size, how energy dense they are and how much space they'll take up, and a few other things that are more operationally sensitive, like temperature ranges and so on. Lithium ion probably is approaching the limits of what's possible in the real world. But it is in the sweet spot. A particular type of lithium ion, which we use, and has been around a long time, is in the sweet spot of where the profitability is in this market, which is, and I haven't really touched on design, but we have batteries which are 1 to 1.5 hours long. In other words, we can discharge continuously at the grid capacity for an hour to an hour and a half, in our case, an hour and a half. That is the optimal amount of time to be able to do that. There are other technologies on the horizon that will be available probably in the next few years, we hope, when the runtime for a battery might optimally be 3 or 4 hours. Now, I suspect what will happen is that when we replace the batteries or upgrade our batteries after 7 to 10 years, which is roughly the period of time that we do that over, you will end up with maybe a different technology. It will still be, it'd actually be quite a different technology, and it takes up quite a lot more space. And it'll be interesting to see whether you, by then, have much cheaper lithium that competes surprisingly well with what would have otherwise come along, or whether you actually make the switch. So there are lots of things going on and to drive down costs, but it won't be really rapid either. There's no massive discontinuity.
Okay, I think there's another question over there,
Please.
Donald.
Okay. Nigel Hawkins, Hardman Co.
Hi, Nigel.
Hello, evening to you. Just want to ask about location. I'm interested in your plant location. Am I right in thinking they're correlated to the weak points of the grid?
No, and they don't need to be, because you can capture the instability and deal with, on behalf of National Grid, with the instabilities in frequency or with the highs and lows from anywhere in the network. It travels at the speed of light. So that's actually not a necessity. There are, just to that point though, there are points on the grid where you have more generation at peak output by wind turbines and so on, where there are effectively weak points, constraints. And in those situations, renewable plants have to be paid to switch off. If we install, and we are installing some in some areas that have that sort of issue, either because of offshore wind coming onshore near there, or other reasons, just onshore wind. And you have a lot of this in Scotland as well, for obvious reasons. A lot of wind in Scotland, most of the wind has been installed up there. That battery projects make a lot of sense in that area to remove those constraints. We're not necessarily favouring those as a core part of the business model, because it's more attractive to focus on the most economical site as a function of the grid connection cost. And so where you locate these really is where the grid connection is possible, where you have the capability.
Just on a different subject very quickly,
Yeah.
Am I right in thinking that sudden outages of baseload plant are meat and drink to you?
Sudden outages of baseload plant create frequency deviations, the very rapid frequency deviations, something the National Grid calls rate of change of frequency events, or just an event in simple terms. Yes, that is meat and drink for the frequency response contract. It can also lead to enormous spikes in power prices, as has happened in the past, in 2016 in particular, where there are some famous events. So yes, the short answer.
Thank you.
Is there one last question? There will be time afterwards. Donald, I think There's someone on your left there.
Just wondering about the cost competitiveness of, for instance, exporting energy when there's a surplus. I mean, so basically, if you connect the UK market better with France, the Netherlands, and so on, what's the rate of return in your projects relative to improving that infrastructure?
Are you talking about the rate of return of installing an interconnector, for example?
Basically, whether that's sort of a competitive threat to you.
No, I don't think so. The reason for that is that interconnectors are not forced to behave in a way that is there to capture the peaks and troughs. They tend to operate for long periods of time when there's a differential, whether it's caused by currency or regulation or something else, and therefore they're not reliable participants in the flexibility opportunity, or haven't been so far. And that's actually been tested and analysed. You know, there's as a capacity factor, if you like. You know, how often are they available to deal with situations where they would be useful? They have not. The other point I would make is that when there's excess generation as a function of a lot of wind or a lot of solar or both, we want to export our power via interconnectors. But guess what? The greatest likelihood is that there's excess generation from solar and wind in other neighbouring countries because the weather tends to be similar across Europe. So you end up with a situation where the interconnector is actually not useful. So that's really, those are the sort of two key points on that.
So, my Scandinavian accent, but Denmark, Norway, and Sweden are pretty closely connected.
Sure.
And sometimes Denmark will have an excess of power,
sure,
primarily because of wind.
Yeah.
They send it to Norway and Sweden, who've
yeah.
got the hydro, which they can sort of switch on and off as they like.
Yeah.
So how come that is being done currently? Is it because of different regulations or other differences?
No, well, I don't know those markets very well, but you know there are always situations where, at the margin, they can help, but they're not necessarily. But it could be driven by price differences between the countries. For whatever reason, and I haven't explored those countries in detail, so I can't answer you very coherently. But the interconnectors are used, but they're not necessarily being used effectively for flexibility events. I think that's the main point.
Okay, thank you very much. I think this has got a low battery, actually. This is why it keeps going off. Ben, thank you very much. There's obviously a chance to ask questions afterwards. Thank you very much, Ben.
Thank you. Thanks, Steve.
Okay, so the next company is Shield Therapeutics. We've got Tim Watts, the CEO, to speak. This company IPO'd in 2016 and has delivered on all its goals set at the time. Principal product is Feraccru, which is a simple treatment for iron deficiency. It fits very easily into normal clinical practice. It's clinically proven, generating sales. I guess the key for investors from here on is the commercialisation of the product. Tim.
Thank you very much. Just a small correction. I'm the CFO rather than the CEO. So, one letter out. So, Shield is AIM listed, as has just been said. We prepared this pack covering February. We had a market cap of about 59 million at the end of January. We're now up to about 65 million. Our primary focus is on developing and commercialising a product called Feraccru, which is for the treatment of iron deficiency. It's a very novel treatment. Commercially, we have already out-licensed that to Norgine, which is a private pharmaceutical company which sells and markets around Europe. They also have a presence in Australia and New Zealand. We have submitted a US new drug application, the so-called PDUFA date, which is when the FDA say they will give us an answer to the review, is the 27th of July of this year. And in the background, we have another late-stage asset, which partly because this company is, as you'll see in a minute, something of a recovery stock, and we had a very difficult year last year. Development of that stopped for a while, but we're starting to put some energy back into that now. We are a semi-virtual company. There's only 15 employees. About half of that is what I would describe as the more senior management and a fairly experienced team there. When we did that Norgine deal last September, we brought in £11 million as an upfront payment, and that means that we are comfortably funded into 2020. Whenever we present, we find we need to tell people about the last 12 months. And you can see there that 12 months ago, or just over 12 months ago, we were riding high with a share price of over £1. The day that a clinical study into chronic kidney disease results came out, that price dropped, as you can see, fell off a cliff, and then settled for a while at around sort of 15, 20 pence. The issue there was a very unfortunate set of circumstances. The reality has been, and I can come to this later, is that the drug itself was absolutely fine, and the study, when all the work had been done to understand it, produced exactly the results that we wanted. So there was because of the way that the news came out, and obviously as a public company we had to announce it, people lost confidence. So the investment proposition really at the bottom here is that this is a recovery stock, and that the recovery of the business from the consequences of that initial announcement of the chronic kidney disease has not yet been fully reflected in the share price. And what you can see as you go from left to right there is that although that the announcement came out on 5th of February, on the 16th of March, the full analysis had been done, and that showed, in fact, that the study had succeeded in meeting all its primary endpoints. But at that stage, I guess the market was pretty fed up with the company and had been let down, and so there was no sort of immediate recovery. At the end of March, the European Union actually extended the usage for which we can, the indication for which we're allowed to use Feraccru. Previously, it had been limited to people with inflammatory bowel disease in Europe, suffering from anemia. At the end of March last year, the European Union extended that approval to treating all iron deficiency in adults, whether or not you had anemia. So that is huge, increases the market substantially. Moving further along, in September, we licensed the drug to Norgine, and that gave a huge amount of credibility. I think people felt that this drug was a wreck drug, but in fact, Norgine came along and they gave us £11 million up front. I've got more details on this later, and various development milestones and sales milestones, and a healthy royalty. But you can see there the share price still barely moved. And then through the fourth quarter, we announced that we had filed our application for the US, and in mid-December, the FDA told us that they'd accepted our filing and confirmed that that PDUFA date for the review would be in July of this year. And it's really, we put all this bits of the jigsaw, if you like, the company back together again. And then I think having done that, we said, we've really, you can imagine the investor relations activity after that disaster was, if it existed at all. By the way, I joined the company in August, so I wasn't around at that time, but it was damage limitation. We've now got the story to tell, and we've started to tell it in the last few months. And actually the closing share price today was around 56 pence, market cap of about 65 million. So we're starting to see a recognition of that this company has got some value in it. Let me tell you a bit about iron deficiency and how Feraccru fits into that. So one of the things that you get from iron deficiency is anemia. It's low levels of red blood cells and hemoglobin. And there's a variety of symptoms of anemia, which you probably recognise, and some which maybe you won't, but it's a widespread condition. And a lot of anemia comes at the point at the bottom, comes from iron deficiency, and you treat iron deficiency with iron replacement therapy. So iron deficiency is the most common cause of anemia. Iron is required for multiple functions in your body, but in particular for the levels of hemoglobin. And deficiency occurs when you're not absorbing enough iron through your food, or if you're losing iron through blood loss. And so malnutrition, bleeding, and those sort of things come up in various chronic diseases, and in particular inflammatory bowel disease and chronic kidney disease. And in those two areas, we've done clinical studies which demonstrate the effectiveness of Feraccru. And these are IBD, inflammatory bowel disease, CKD, chronic kidney disease, are significantly prevalent diseases. And these charts go from 2017 to 2035. 2035 because we have patent protection for our drug out to 2035. But you can see today on the left-hand market, we're talking about around about 15 million patients with these two diseases in the 5 biggest European markets and the US, and growing steadily with aging, population growth, and so on. So these are in themselves are substantial markets, but this is only a subset of the entire iron deficiency arena. So you can treat iron deficiency either orally or intravenously. Essentially, the oral products historically are salt-based compounds. They're inexpensive, they're convenient, but they tend. What happens is you take an oral salt, it will break down as it goes through the gut, and you end up with sort of iron effectively clumping in your gut and causing constipation, nausea, vomiting, and affecting the lining of the gut. And as a result, the oral salts are pretty poorly tolerated, which creates obviously an issue for those people. Now, for more severe cases, you can go on to intravenous, but that requires literally a direct injection of an iron product into your blood supply. You have to go into hospital for that. You can have a very significant reaction to it. It can be quite dangerous. So the products themselves are expensive, and obviously the hospitalization costs are both inconvenient and expensive as well. And you can see there in terms of market volume, because virtually everybody will go on to the oral treatment initially, that's where the big volume is. But in terms of pricing, most of the oral products at the moment are generic pricing, and the intravenous product on the right-hand side, the lighter grey colour, essentially about half the market in value terms comes through the intravenous treatment because of the pricing of those products, which are mainly patented products. So why is Feraccru novel? In what way is it novel? So what I said a moment ago, that the salts break down as they go through the gut, and so you lose a lot of the iron before it gets to where it needs to. You can be treated, an iron salt tablet can contain 200 or 300 milligrams of iron, and a lot of that doesn't get absorbed where it needs to be. Feraccru is different. Feraccru is an Fe3 plus iron surrounded by 3 essentially sugar molecules, maltol. And they bind very, very tightly until it gets close to in the duodenum where most of the iron gets absorbed, when the strength of this natural body process is strong enough to pull the iron out of that conglomeration, and it pulls it into the body, and then the body uses it as it needs to. And the maltol, which is essentially a sugary stuff, which is actually used quite often in the food industry, simply gets discharged through the body in a natural way. So there are really very, very few side effects from this treatment, and most of the iron that we give in the capsule gets to where it needs to. And as a result, I said 200 or 300 milligrams for an iron salt tablet. Our capsules are 30 milligrams, so we're giving far less iron. So where do we position Feraccru in the sort of overall treatment? So you get a patient treatment with iron deficiency, pretty much all of them will initially go on to oral iron. And some, going down this route, will be tolerant. And because the drugs are cheap, fine, let those people, that work. If it works for them, we're not going to try and capture that market. But if you're intolerant, and some studies say that ranges from 50 to 70% of the patients, so a huge population, you've got 2 choices. Either you give up and you just put up with your symptoms, whatever they are, or you go down the intravenous route, which, as I say, is expensive, inconvenient, and unpleasant. So what we are now being able to offer with Feraccru is 2 alternatives. Either instead of giving up, take Feraccru, so that sort of grows the market, or instead of going down the intravenous route, take Feraccru, which should enable us to take some of the intravenous market. And we are aiming to price, and Norgine, our commercial partners in Europe, are pricing this at around the same price as the intravenous product. So we're not priced at generic prices. We're priced at the higher intravenous product rates. But of course, we're saving the system all the costs of hospitalization and so on. So we can offer a good economic case, even though we're charging those sorts of rates. And just down here to note, as I mentioned earlier on, patent protection out to 2035. Clinical studies. The first clinical study the company did was in inflammatory bowel disease. The top chart shows you what happened over the 12 weeks, which was where we got to the primary endpoint. And that basically says that we got the sort of increase in hemoglobin that you need from 11 up to 13 or 14 or which is the sort of level where you're normalizing and stabilizing. So we saw a very relevant increase in hemoglobin over the 12 weeks. And then the middle chart is over the 52-week, sorry, I think it's 64-week follow-up for this one. And you can see there that the levels are sustained out over that period. And the bottom chart basically says it's well tolerated. The blue is Feraccru, the red is placebo, and we had similar sorts of adverse effects during the study to a placebo. This is the detailed story of the chronic kidney disease study, and in the interest of time, I'm not going to go into this, but this is how we what happened and how we retrieved the situation. Essentially, what caused the damage was we got top-line data out of the clinical research organisation that conducted the study, and that top-line data masked the fact that some of the patients who had been treated with Feraccru actually had severe blood losses towards the end, and therefore their hemoglobin levels suddenly went down. And some of the patients who were being treated by placebo, who weren't improving, because of other effects, they had to be treated with emergency intravenous or other therapy, so their hemoglobin went up. In the initial data, we couldn't see any of that. All we saw was there wasn't much difference between the two products at the end of the study. Once we'd adjusted for those confounding events, actually the separation was right. So Feraccru actually delivered a much better result than the placebo. But it was only after those 6 weeks, towards the middle to end of March last year, when all that full information was seen. And actually, recently we've published some the long-term data from the study, and this is the original data for the 12 weeks, and so. You can see here that after correcting, the benefits at week 8 maintained themselves out to week 16. In the top line data, this all disappeared. So that was the puzzle. It was great here, and it had all disappeared by week 16. But what you can see in the long-term follow-up is these are the patients who were originally on on Feraccru, going out to 16 weeks. These were the patients originally on placebo, and after the 16 weeks, we were allowed to move the placebo patients onto Feraccru, and you can see they then reacted in exactly the same way as the Feraccru arm had done 16 weeks earlier. So really good, nice long-term evidence that this is a valuable product.
Tim, you've got about 4 minutes.
Okay. We've got some other studies going on at the moment. The main one, there are two here. The bottom one is a phase 3 paediatric study, which the European authorities have asked us to do. At the moment, we're only approved for adults. This will allow us, if it's successful, to go right down into treating children. The one in the middle, the head-to-head study, this actually is going to report by the end of this quarter, so it's going to be news sometime fairly soon. And this is where it's not a regulatory study. The regulators ask you to essentially compare your drug against placebo. This is where we've gone head-to-head against the market-leading intravenous product, because what we want to try and demonstrate is that actually if you treat your patient with your oral Feraccru, it's as good as treating them with the intravenous treatment. And clearly from a marketing point of view and a pricing point of view, that could be a valuable result to get. But if we don't get it, it's not a disaster because, as I say, it doesn't impact the approvals. In terms of European commercialisation, I mentioned we've licensed it to Norgine. We got an £11 million up front. We're entitled, if we have success, to an extra 54 million euros in both the mix of development and sales milestones, and we will get royalties ranging from 25% to 40%. I won't go into this much detail, but Norgine are a very credible company. Then they're sort of mid-size. We didn't want one of the giants because, frankly, this product probably wouldn't be interesting enough to them. But Norgine are highly motivated, and they already operate with the same sort of doctors and so on who you need to promote these sorts of drugs to. We retain responsibility for manufacturing, future development, and of course we own the the overarching intellectual property. In the US, we filed and we'll get an answer around the end of July unless the government has another close down over there. And commercialising, we're most likely to out-license the product there as well. In terms of financial headlines, we put out an unaudited trading statement in January. 11.9 million of revenues in 2018, of which 11 million was that upfront that we received. We've got cash of nearly 10 million at the end of the year, with a cash runway going into 2020. In terms of news flow, we've got those head-to-head study data coming out quite soon. We've got the PDUFA date for the US in 27th of July, and the start of the paediatric study. We're still doing the preparatory work for it at the moment, designing the protocol. We need to find and appoint a contract research organisation to do the work for us. But that should start in the second half of the year. And then ongoing, we are continuing to look at out-licensing. So there's the US, which in due course, hopefully we'll be able to do a licensing deal for, but also other territories outside the US and Europe. So key messages and investment highlights. This is a major market, and there are significant unmet needs because of the tolerability issues. Feraccru is novel in the way that it works. We've got the US coming. We've got other parts of the world coming. We've got a fairly healthy cash position. And we believe we have a valuation upside as a result of the calamity that happened last year. And we've got, and we're now covered by Peel Hunt and Liberum, who are our brokers. And Liberum actually recently updated their note and put a price of, I think it's about £1.10 on us, including the US opportunity. Peel Hunt put a note out at the time of the Norgine deal, and they said 70 to 80 pence, excluding the US, and you can double that if you get the US approval and licensing deal. And also Edison cover us. They've got 150 for the total business, including the US. So you can see there that all those analysts think, compare that with today's share price of 56p, that there's a healthy upside. That's it. Thank you very much.
Thank you. Questions from the audience? There's one over there.
I apologise. Our Chief Medical Officer was going to come with me, but he unfortunately wasn't able to. So your more medical questions, I'm afraid I'm probably not going to be able to answer.
Okay. Have you got any guidance you can give us on pricing and what Norgine is saying about the price they can achieve? And second part to the question is, what kind of distribution capability does Norgine have in the United States?
So pricing, Norgine don't have any real presence in the United States, so it's pretty unlikely we'll do a deal with them in the US. In terms of pricing in Europe, it's around the sort of €2. It varies from country to country. At the moment, we're only launched. The product is only launched in the UK and Germany, because traditionally those are the markets where you can go to and you can set your own price. And as far as the other big European markets, France, Spain, and Italy, typically there you have to go through a price negotiation before you can launch. Norgine have said, and there's an element of crossing your fingers here, we don't want to go and have those pricing discussions until we've seen the head-to-head data, because if we get good head-to-head data, then we can argue for a better price. But I think you're looking at the sort of €2 per day mark for the treatment, and the treatment is 2 30-milligram capsules per day.
Could I just ask then, as far as the US is concerned, assuming that the FDA does accept the product and admit it to market, who you'll be looking for a distribution partner there as well?
We will, yep, and that's a process that's underway, but it's still early yet, and I don't think we would want to conclude irrevocably a deal before, and I don't think the other party would want to conclude a deal before we get their approval one way or the other.
Okay, thank you for that. There's another question over there, Donald.
Can you tell us a bit about where your costs are going and what the variables are, please?
Yep. So a bit when at the time that the data problem happened a year ago, the company had set its heart on commercialising for itself, certainly in Europe, and had started to build commercial organisations in the UK and Germany, because those were the first markets. The day all this happened, the share price collapsed. The company was relatively short of cash and just took the view that it could no longer support those commercial organisations. So it took out all the selling and commercial organisation, and along with that downsized the back office and so on. So I can't point you to an exact number at the moment in terms of looking at 2017 or 2018, because the costs were coming down like that. That said, we've probably got a general and admin sort of cost of running the business in the region of about £5 million. The variable is how much R&D cost do we put on top of that, and I'm afraid that bounces around all over the place. During the course of 2019, we've got the tail end of the costs from the head-to-head study, and still some residual costs from the chronic kidney disease study, because we did the follow-up. We will have, towards the second half of the year, we will have the paediatric costs beginning to start. And in the meantime, we've got some formulation work we're doing. So, for example, for the paediatric study, we can't ask small children to take capsules. We're going to have to give them a liquid. So we're formulating that at the moment. So I'm afraid the R&D piece is a bit of a moving piece. But you've got the sort of underlying bedrock at the moment of costs to keep the business running and so on, of about 5 million plus on top of that, R&D costs.
Thank you.
Okay, is there a final question? Okay, thank you very much.
Okay, thanks.
Thank you, Tim. Of course, there's the opportunity to ask Tim questions privately afterwards. And again, I'll remind you about the feedback form, so please fill in those forms as you go along. We'll be very grateful for that. The third company tonight is a life science company as well, but it's in a rather different field, Collagen Solutions, that has spoken at this event before. Develops, manufactures and supplies medical-grade collagen biomaterials for use in research, medical devices and regenerative medicine. Growth in the market for biomaterials is driven by demographics and innovation, and Collagen's well positioned for growth through multiple growth initiatives on a foundation of existing revenue and a growing customer base, and a number of proprietary products nearing launch. Jamal Rushdy is with us tonight, the CEO. Jamal, over to you.
Well, thank you to Hardman for hosting this event, and I see a few of our shareholders here in the audience, so thanks for attending. And for those of you new, I'm really excited here to present the opportunity with Collagen Solutions. So let's talk really quickly about just the investment value proposition here. There's really three things to consider. First of all, as was alluded to, the market for biomaterials is high growth and sustainable, and it's driven by some natural underlying drivers in terms of demographics, innovation within materials, and it goes across a number of segments. So this is not a single medical device segment, it's multiple segments within medical device. In particular, Collagen Solution is very well positioned for growth. We do have multiple growth initiatives, so it's not a single study that has to come out good or bad, or it's not a single market that has to come out good or bad. We've been placing the seeds of the last 3 to 4 years, and very happy to see on the cusp a number of those investments being realized. And then finally, you can't do this without a team. I'm proud to say we've got a phenomenal team that we've put together for Collagen Solutions. We have experience, many of us within decades of experience in medical device, and we've also had experience in biomaterials, and many of us have been in the smaller company environment transitioning into bigger companies through acquisition, and been able to create value for our shareholders across a number of investments. So we do have a track record of making this work. So let's talk about the underlying demographics. What's driving the opportunity? So what's interesting is by 2030, 1 billion people will be over the age of 65, and that's growing at 5 times the rate of the rest of the world's population, so of any other demographic. So we are having an aging population, and what happens with aging is there's two things. There's the expectation of improved quality of life as we age. So no longer are we satisfied at 65 years old, 75 years old, with dealing with suffering. So there is an expectation for even continued sport, continued activity. The downside of aging, of course, is also increased amount of chronic disease that happens. So with this aging population, there is both the expectation for prolonged activity and the need to deal with some of these disease treatments. So in biologic materials, there's a lot of innovation that are happening. cartilage for arthritis in the knee, so improving walking and gait in the knee. Synthetic bone grafting when it comes to spine surgeries, an area of biologics. Diabetes is a big problem associated with obesity and aging that biologic therapies can help with the wounds associated with diabetes. Heart valves have now become minimally invasive, believe it or not. You can go into the cath lab and get a replacement heart valve these days, again, based on some biologic materials. And then finally, as people age and their teeth need to be replaced, there's biologic therapies approach to that. So none of this is science fiction. None of this is tomorrow. These are all innovations that are happening today, and Collagen Solutions is a part of all of this. So getting to what we do, we develop biomaterials and medical devices, and these are typically meant to restore structure and function of damaged tissues and organs. So we'll get into some examples of that, of what we do. So we see a number of vertical markets here in medical device. In cardiovascular, our tissues are used in minimally invasive heart valves. In orthopedics, our collagens and our products are used for bone grafting and the healing of cartilage in knees. In dental, we use our collagens and other products to restore the bed upon which these dental implants are implanted. And then collagen finally is a very natural wound healing agent. So across wound healing, which is especially prevalent with diabetic patients, collagen is used in a number of these areas. Those are the major markets that we're in. We also are in the front end of research. So collagen is used in some of the more advanced research that's going on. It's not a lot of revenue for us, but it's important to be at the forefront of regenerative medicine so that when these therapies ultimately get to clinic and ultimately get into development, we're at the beginning of that as well. So those are some of the major markets that we serve today. So from a business model perspective, we do about £4 million in revenue today. Our core business is 100% of that revenue, where we supply, develop, and manufacture both collagens and tissues made from animal sources for many medical applications. We have several growth drivers that's driving the growth of our underlying core business. So one thing that we've been doing over the past years is moving up the value chain. So 3 years ago, we were mostly a supplier of raw materials. Medical-grade collagens and tissues, we'd supply it to other manufacturers, and those manufacturers would then make their own products. What's happened is we've been moving up the value chain where we're actually now developing products for these companies using our raw materials and, in fact, making some of our own products. What that translates into is where before we might have captured 2 to 5% of the average selling price of a medical device, now moving into development and ultimately contract manufacturing, it's more like 30 to 40% of the average selling price. So that has been happening over the past few years, especially this year's, where we really see the step change. We've also been broadening our offering of tissue products, again, from very simple one product company to multiple species and multiple types of tissues for medical device companies. And then finally, 3 years ago, we started an initiative to build a sales organization so we can expand geographically. So we now have business development professionals in the United States, in Europe, and in Asia to go deeper into those markets. And those are all our key drivers that's been growing our core business. Now, on top of that core business, what we can do is we can leverage the expertise and the contacts we have to develop some of our proprietary products. And these are products that we will take all the way through the regulatory approval process, getting feedback from surgeons and some of our partners in industry. And our first lead product is nearing launch, and that's a product that I'll get into a little bit more, but it's a scaffold to regenerate the cartilage in a damaged knee, and that's really a game-changing product for us, and indeed we believe the industry. So that's our business model. Core business with, on top of that, new products that are coming out. Here's been a little bit of our history of our revenue trend. We've been growing nicely over the last several years. Last year, we also had a challenging year that we had to recover from. A couple of customers had some challenges with either funding or their own product that they had to step back. We believe nearly all of that will come back in the future. But even with those challenges, we ended up growing in the first half of this year. Our fiscal year ends on March 31st. So we reported out in December, we reported out our first 6 months of this year. And despite some significant customer challenges, we grew by 13%. In fact, with one customer that will come back, we believe in the future, if you take that one customer out, we grew by 55%. So we've really been growing the baseline of the business. One leading metric is the number of new customers that we onboard every 6-month period. We onboarded 9 new customer contracts in the first 6 months, and that was a record for the company. So we're really seeing the momentum coming through in terms of customer growth. We've been growing in China, so we did an initiative. We had a couple of challenges early on to figure out the right path. We believe we found some good opportunities. 2 new distributors, and we've started to realize our first sales in China. And then our tissue business has been taking off with 4 of the new customers coming through there. And then finally, in terms of moving up the value chain, moving from raw materials to development and then contract manufacturing, 50% of our revenue this year is coming from development contracts that then translates into contract manufacturing once those products are approved. And that's up from, say, 5 to 10% from years past. So we've really significantly changed the mix, and we've been moving up the value chain in our core business. So we're quite pleased with the first 6 months of the year, and we'll be reporting out our full year revenue after March 31st, likely in the early April timeframe with a top line unaudited number. So that's a bit of our core business of what we do, and now I want to focus a little bit on our first proprietary product that's coming out, which is called ContraMimetic. So this is for disease of cartilage in the knee. If you know people have painful knees, the cartilage gets worn down, this is one of the therapies and treatments to intervene and we believe prevent some of the spread of the disease over time. It's an arthroscopic procedure, and that's what's known over here in Europe as a keyhole procedure. 2 very small incisions, maybe 3, with a camera and some instruments. It comes in a complete kit, as you see there. And what's interesting is it's not only cost effective, but it's going to be backed by 8 years of long-term follow-up data. So this is almost unheard of, is to be able to launch a product with this type of data behind it, and we're very excited about the data that we see. So we'll talk a little bit about what happens to a knee as it ages. So you start there on the left with a healthy, pristine knee. It's a very shiny white surface that takes the loads of walking, running, jumping, etc. And then, either just because of wear and tear, because of age, or perhaps an injury, you start with a small defect. Now that defect can grow over time into late osteoarthritis, where the bulk of your knee is damaged, and then you have to go to a metal and plastic knee. So that's the end stage of arthritis, potentially to even have to be revised down the road. So what we'd like to do is intervene in this area before we have to get to that total knee progression, or at least to prevent and delay that progression, which will save the healthcare system billions of dollars over time. So again, we're at that that early stage where currently there's about 1 million cartilage procedures worldwide performed to address this problem, and frankly, many of those procedures don't work very well in the long term. They're not sustainable. We believe we can address about 1/3 of those on a global basis through our technology, and that's going to be the earlier stage cartilage defects. So what makes us different with this product, and how is it going to be effective? It's hitting that sweet spot of, can we be cost effective? Can we show long-term durability of the data? And it's just human nature. Is it easy to use for the surgeon? Because if it's a big learning technique, it's going to limit, hurdle, it's going to limit adoption. So we've developed a therapy that we believe is going to be about 10% of the cost of some of the more expensive cell-based therapies that do work fairly well, but they're very costly and they're very time-consuming and difficult to do. We're going to show we have shown 8-year long-term follow-up data that shows the efficacy. And then finally, it's exactly in the current technique that the surgeons know how to use today, and it really doesn't add any time to the surgical operation of the techniques that we're doing today. So we think this is going to hit the sweet spot of all 3 of those areas. So cost-effective, easy to prove, that's just math. Ease of use is very similar to the procedure today. So let's talk about the durability and how can we prove that. So this was the subject of a very long-term clinical trial that we were fortunate enough to get some of the early patients back, and we were able to image them and get the functional data from 15 of the 17 original patients. The first thing we looked about is, does our scaffold, which is our product, refill acceptably the bone and the cartilage in the defect that we've created? Current standards of care is maybe 50 to 70% of the defect being filled. Here we saw 95% of the defect being filled, and those are the individual patients. So they're very consistent. It's not like we had a few anomalies. So we're very happy with the fill. So we know we can fill the cartilage, but will it last? And there's two ways to know if it lasts. One is you get the clinical scores, but the other one is you can image it, and with new techniques, we can tell if we're regrowing scar tissue, which is why some of the current therapies don't last very long, or are we actually regenerating normal native cartilage. And from this next part of the study, we were able to image that. And so it's a bit technical, but what you'll see here is an 8-year time period. The blue is chondromimetic. It's the signal that measures normal cartilage, and the green is what a normal cartilage signal looks like. Now, we looked at the first few weeks, we looked at 3 months, and we looked at 6 months, and those are the early time points on the right, and we saw very rapidly converging to normal native cartilage. And then we looked 8 years later, and the statisticians and the data could tell absolutely no difference between normal native hyaline cartilage and on this test, and then our regenerative scaffold. So we were absolutely amazed by this data. We thought it was going to be close, but this is statistically indistinguishable. In fact, the error bars, you can't even see them. So we're very, very happy with how this came out from a regenerative process. So that satisfies us scientifically. And then what's important is how does it work clinically? How do the patients feel? And there, again, we were very, very happy. The top graph is a longitudinal graph of a functional score, which basically measures patients' pain, quality of life, sports, etc. And anything in the scoring range between 80 and 100 is considered excellent. And we saw that we had early, very, very good results, or excellent results after the first 6 months. But we found that was sustained over an 8-year period. And this is thinking about someone aging normally over 8 years is not going to have the same level of function either. So we're able to see very normal and sustained functional results over that 8-year time period. The second graph, which you see on the bottom right here, these are subsets of a different type of clinical score that we looked at, we compared against these cell therapy that cost 10 to 20 times as much. And what we found is on every measure, the symptoms, the pain, the quality of life, the activities of daily living, the return to sport, we were equal to, if not better, these products that cost 10 times as much. So we think not only do we have a very good argument on an absolute basis, but relative cost of the healthcare system, we can show some very good results in these early stages that you don't need to spend as much on the cell therapies, and it's much easier for the surgeon to do. So we're very excited about this product. So we need to launch it. Sorry.
About 2 minutes.
2 minutes, that's all I need. So our next step, first we're going to launch it in Europe, and then we're going to follow on very quickly in Asia. The US will be a little bit longer of a clinical trial, so we'll have to find a partner for that. We've submitted for the CE mark. We're simply waiting for approval. That they've started the review as of early January. We have not heard back yet. We're hopeful to hear back very soon. We've already signed up distributors ahead of the CE mark, so there's a lot of excitement around that. We've got our key early distributors identified in Europe, and in fact, we've also started to license this in Asia. So in Indonesia and Malaysia and in South Korea, we've started the process there. As soon as that's available, we'll be beginning our first surgeries with our key opinion leaders, and then we'll be launching the product both in Europe and Asia. So just in conclusion, our catalysts, our news flow, if you will, over the coming months and next year, we'll be continuing to grow the core business as we get new agreements. We have a very healthy deal pipeline. We have milestones upcoming from our existing development projects. Some of our customers' products are about to launch, which will pull through on our supply side, and then we see acceleration in our tissue business coming through. We'll be launching chondromimetic as soon as we get the CE mark with first limited user release, and then expanding our distribution from there. And then finally, it's important to invest in the future. So we have a pipeline of products behind that. And in fact, just recently, we announced 1.5 million pounds of support on a matching grant, 40% matching grant from the Scottish Government, since we're headquartered in Scotland, to continue to fund our R&D and our innovation. So we have a pretty aggressive vision to be the industry's first choice in regenerative biomaterials, and we look forward to getting there. Thank you.
Jamal, thank you for that. Are there any questions in the audience? There's a question over here.
Just a little one I should probably ask the previous speaker as well. Do you expect any issues around Brexit with regard to your sales into Europe, or are life science products exempt from that?
The short answer is we don't expect a major impact right now. Our notified body is Dutch anyway. Our distributors are going to be set up there. There's probably going to be some incremental costs and inefficiencies that would happen. I don't think that's really unique to our industry. And the regulatory environment, we believe, is going to stay fairly consistent. Down the road, who knows? So far, all the analysts are saying it should be business as usual, but we do keep a watchful eye open in case any of that starts changes. But whatever happens to us, I think, is going to impact the industry overall. But so far, what we've heard is from a regulatory environment should be business as usual. We do expect some inefficiencies in terms of potential extra inventory to be staged in certain areas, especially in the short term and uncertainty.
Thank you.
Is there a second question from the audience? There's one there.
Can I ask, when that particular problem for the overcoming the need problem, when that's going to come onto the market, do you think?
So it could be weeks and it could be a few months. We're not exactly sure. It's certainly not years. The process for getting approvals, we submit all the data to our notified body to get the CE mark. They then have a chance to answer or to ask us questions that we have to answer, or they just approve it. Typically, we would expect 1 or 2 rounds of questions. Each round could be 4 to 6 weeks. We haven't received our first round of questions yet, so it's a bit of a waiting game, but it could be weeks or a few months. That's our best guess right now.
Okay, and I think there's a final...
Then how would that get into surgery? It would take time to do that as well, wouldn't it?
No, it's fairly quick following the approval because of our distribution network.
Oh, right.
Okay, I think there's another final question at the back.
I just wanted, you mentioned you had a customer who was a fairly substantial customer who went away.
Yes.
What can you tell us a bit more about why that was?
Yes, we talked about this fairly publicly. We had a customer in South Korea that we had a 5-year contract with certain minimums, and they were very honorable and honored their minimums, but their sales haven't gone as fast, so they've ended up building up some excess inventory. It's going to take them a little time to work through it. We're still in contact and have a very good relationship, so as soon as they work through that inventory, we expect it to come back.
Okay, thank you. Obviously, a chance to ask questions in the private session afterwards. Thank you very much.
Great, thank you very much.
Okay, so the final company speaking tonight is Anglo Asian Mining. We've got the CFO with us, Bill Morgan. Now, I think most investors know that essentially gold is an uncorrelated asset for difficult times. I guess the question is, why Anglo Asian? Well, the gold mining sector is full of companies that have got holes and prospects, but not much more at this stage, whereas Anglo Asian is highly cash generative. It's a miner of gold, silver and copper from 3 mines in Azerbaijan, listed on AIM in 2005, produced its first gold in 2009, paid its first dividend in 2018, and the balance sheet moved into a net cash position. Yesterday announced dividend guidance for this calendar year of 6 US cents on a share price of 82 pence. Bill, over to you.
Well, good evening, ladies and gentlemen. Thanks for coming. My name is Bill Morgan. I'm the CFO of Anglo Asian Mining. Keith has just actually been through all of the best bits, so I can keep this presentation very short. This is a group overview of the company. We're very established, as Keith said. We were listed on AIM in 2005. We produced gold in 2009. We've got a very experienced board and very strong management, and we've got an excellent relationship with the government in Azerbaijan, which is a very stable jurisdiction. I like to joke about the fact that the company politically is more stable than the one we're sitting in at the moment, but I don't think that would be a very good idea, as you all have to live here. Our main site is Gedabay in western Azerbaijan. This is in the foothills of the Caucasus Mountains, and there we've got our 3 mines and our processing facilities. And we've got very highly developed infrastructure. We've got very good road access. We've got a substation at site which we built where we get power from the grid. And as well as being a producing company, we've got a very good pipeline of exploration projects and potential for future mines. To give you an idea of the production and the financials of the company, we've got growing production. Last year, and this is calendar years, we did just over 83,000 gold equivalent ounces. That's gold, silver and copper. We're guiding this year for 82 to 86,000 gold equivalent ounces of production. Our financial years are calendar. We've not released the results yet for the full year of 2018. The last financial results we released for the 6 months to June of last year, where we posted revenues of 40 million and profit before tax of just over 8 million. And we currently have net cash. We're a very low cost producer. If you look at the gold industry, the last AISC, all-in sustaining cost, that we actually released on the market was the 6 months to June of last year, where we had a cost of $543 per ounce, which is very low. This is partly because we're very well served with infrastructure and we're an efficient company, but partly because Azerbaijan is a very cheap country to actually operate and do business in. As I said, or Keith said, we just paid our first dividend last year because of the good cash flow that we had. And we've got a dividend policy of targeting 25% of free cash flow each year by way of 2 dividends each year, an interim and a final, which are roughly equal. And we paid our first maiden dividend of 3 US cents. We declare in dollars, but we actually pay in sterling using an exchange rate close to when we pay the dividend. This is to give you some idea of the shareholders of the company. If I can get the button working. Risa Vaziri and Governor John Sununu, they hold just under 40% of the company, and they were actually the founders of the company. Between them, the rest of the directors and the senior management, we own just over 41% of the company. So, you know, we're very much invested in what we're doing. Last year, the company had a very, very good share price run. We basically doubled the share price from around 40 to around 80, and that was on the back of the very good results that we announced, plus the dividend that we announced. Can you still hear me without the mic? Yeah, sorry, I'm getting confused here with microphones. And we will be releasing our full year 2018 financial results in the middle of May, and we're going to have an annual general meeting on the 20th of June. Okay, as I said, we've got a very strong team. Risa Vaziri, he set the company up. He's a very prominent Azeri, he's a very prominent businessman in Azerbaijan. He's originally of Iranian extraction, but he's now a US citizen. He's been doing business in Azerbaijan for a very long time. He's a personal friend of the president, and we're very well connected and part of the political establishment. He set the business up along with Governor John Sununu. He was the chief of staff to the first President George Bush. Khosrow, he's our non-executive chairman. He's in his 70s. He spent a long career with the IFC and World Bank, and he now acts as a non-exec chairman for various companies in that part of the world, where he did a lot of work for those institutions. We've got Richard and John, they're both English. They're non-execs from the finance and the technical disciplines. John is actually sitting here in the audience. And in terms of the management, we've got myself, who's the CFO, Farhang, who's our technical director, and Stephen, who's our geologist, and he's Welsh. Okay, this is a little bit about Azerbaijan. It's, as you can say, it's a small country on the Caspian Sea. We run the company from the capital in Baku, and as I say, our 3 sites are Gedabay, which is the main operating site of the company in the Caucasus Mountains. We've got another site, or another concession at Gosha, which we've got a small underground mine. And we've got Ordubad in the Nakhchivan enclave of Azerbaijan, which is an early stage project where we're doing some geological work. This is an overview of the Gedabek site. This is about 1 mile from the village of Gedabate, which is by a main road. And there we have the main open pit mine there. We have a mine camp and we have offices. We have our processing facilities there. We've got a second open pit mine, which we call Ugol, which is 4.5 kilometres from the processing facilities. And this is along a road that we built to actually get access to it. And we also have an underground mine there called Gadir, which is the portal, which is situated 600 metres from the processing facilities. And as I say, this is well served by road. We've got power from the grid. We've got a local labour supply, so it's very easy to operate there. This is a quick summary of our 3 mines. This is the main open pit mine. This is the back wall of the mine, and in the background there you can see the village of Gedabay, so that gives you an idea of how the mine is situated according to or in conjunction with the local population. This has been producing since 2009. We did 362,000 tonnes at just over 1.6 grams, and it's got a mineral resource of just over 1 million ounces of gold and 95,000 tonnes of copper. Okay, this is our second open pit mine, which was Ugol. The notable thing about Ugol was that we discovered this in October 2016 and we got it into production in September 2017, which is just over a year. And for those of you who know the mining business, this is phenomenal. It normally takes about 10 years to develop a mine. A lot of that is due to all of the permitting and the environmental impact assessments and the whole range of things that you need to do. We don't have to do any of that because within our 300 square kilometre Gedabek concession, we're actually free to do what we want. So if we find a deposit, we can just go ahead and develop it, and away we go. And as a result, we got this into production within a year. It's got ore reserves of about 200,000 ounces of gold and just over 1 million ounces of silver. And there's no copper here, whereas with the open pit mine is grading about 0.5% copper. This is actually just gold and silver. This is the Gadir underground mine. This was a fairly entrepreneurial piece of mining that we did. We discovered the resource on some fairly limited geological data, and then rather than actually do a long study and a feasibility study and a lot of geological exploration work, we actually just sunk a decline into the ore body and started mining. And it's worked very well. So it's been in production since 2015. Last year we did 125,000 tonnes and it's grading 4.5 grams per tonne. And this is good ore, and we've just published an ore reserve and a mineral resource last week of 172,000 ounces of gold and 3,800 tonnes of copper. This slide is my favourite slide. It's not so fearsome as it looks. And this gives you the background to the company's processing, and it's basically designed to be read from the top clockwise. So when the company started, it started by doing fairly simple heap leaching of crushed ore, which is you just take the ore, you crush it, you put it into a pad, you pour cyanide over it, and that trickles through, and you extract the gold from the dissolved cyanide. The next stage in the company's development was a SART plant. This was just a plant to get the copper out of the residue from the heap leaching process. The next stage was to build an agitation leaching plant. This is basically where you get big tanks of cyanide and ore, and you have shorter residence times. And then you take the gold out of there without getting too technical. It's very similar to a carbon-in-leach plant, which people who know the gold mining industry are familiar with. The only difference between what we do here is we use resin for the deabsorption rather than carbon. The next stage we do some heap leaching of uncrushed ore. This is for low-grade ore where we just take the rocks, we just pile it all together without crushing it, and again we irrigate it with cyanide and take the gold out that way. And the final processing plant that we built was a flotation plant. This is a very different technology, and we use it to extract the copper from the ore. We were running the flotation plants and the agitation leaching plants together. We would put it through the flotation plant first and then through the agitation leaching plant. And the reason for that was we were limited by the amount of crushing and grinding capacity that we had. But last year we actually commissioned a second crusher and grinding circuit, well, not circuit, line. And we're now actually operating both the flotation plant and the agitation leaching plant as two separate processing plants in parallel. Okay, this is just a view of some of the things we've done. As I've said, we put in a second crusher line for the flotation plant last year, and this is a picture of the jaw crusher, and this is a picture of the SAG mill that we use for the grinding. This was a thickener that we put in for the flotation plant, and again, you can see an idea of the topography, and this is some of the mining equipment that we've been buying. The company 5 years ago was fairly heavily in debt. It had over $50 million worth of debt and was fairly struggling to survive, but we've turned it around fantastically over the last 5 years, and because of that we're now able to spend money on things like renewing the mining fleet and bringing the project up to scratch.
Bill, you've got about 3 minutes.
3 minutes, okay. On the exploration program, we're doing a big exploration program. I won't go into detail, it's here if I've only got 3 minutes. The main thing that we did last year was a helicopter survey of the entire Gedda Bay site, and in simplistic terms, we basically flew a big metal detector over the whole ground. So big you need a helicopter rather than a pole, and we're waiting for the results for that to come, and we will be announcing the results of that survey at the end of March. We have another early stage project in Azerbaijan, which is the enclave, and at the moment we've got some geologists doing some work, really interpreting Soviet data and trying to get their mind around exactly what we've got there. It could be 3 or 4 years before we do anything there, but obviously this would fit in nicely with what we're doing at the other mine site, and there's potentially big projects there. Okay, quick financial highlights. I think we've been through this. We've been through the revenue. We had very strong cash flow last year. We turned around net debt of 18.1 million into net cash of 6.1 million. We paid our maiden dividend. We're guiding for both the full year 2018 and this year 2019 of paying a minimum of 6 US cents per share. And the contract with the government is fairly complicated, but at the moment we have an effective royalty of 12.75%. As you can see, our production has been growing nicely. It grew 17% year on year last year, from 71 to 83,000 gold equivalent ounces. And this year we're guiding 82 to 86,000 gold equivalent ounces. It's not so strong an increase as last year, but we are demonstrating that we've got sustainable production from the mine. And really this is the last slide of why invest in Anglo Asian. We're established, we're experienced, we've got a first mover advantage in Azerbaijan, we're cash generative, we pay dividends, we're increasing the investor profile of the company, we've got the fast track ability, and we've still got a lot of exploration potential to take the company forward, both organically at Gedda Bay. Obviously we've got the Azerbaijan project that is a bit more down the track, but there's another area to grow the company. And we've started to think maybe that there's a bit more to the mining business in Azerbaijan, but that's difficult in terms of moving outside the country, but that's something we keep an eye on. So, Anglo Asian Mining.
Bill, thank you very much for that. Do we have any questions in the audience? There's one there.
Yes. Could you give us a rough idea of how much capex you've done to get into production?
In total, we've done getting on for 100 million, I think. The main part of the capex was the agitating leaching plant. That was 50 million. Then you've got all of the other mining equipment, the cost of developing the mines. The flotation plant actually was pretty cheap, but you're looking somewhere between, I think, about 80 to 100 million off the top of my head from what we're doing.
So a second question in the audience. There's one over here.
Bill, thank you for that. You've got a very commendably low all-in sustaining cost. Could you talk to your cash cost, please, and then also arbitrage that back with the previous question in terms of how you account that vis-a-vis CapEx, particularly with your need, I think, for further exploration to prove up your resources a little bit, given your current production?
I couldn't give you a cash cost figure off the top of my head. Obviously, it's going to be lower than the all-in sustaining cost. I would imagine, as I say, off the top of my head, it's around about $500, thinking about what our capital cost was, or the capital part of the all-in sustaining cost. Sorry, in terms of taking that into our capital?
Well, just arbitraging against the capital cost vis-a-vis Marcus's question, because you've clearly got quite a lot of exploration to go ahead, and you clearly need to prove up your resources a little bit, given your annual production, if you agree with that.
Yes, I mean, the fact is that because we've got these very low costs, and we're cash generative, we are able actually now to fully fund the geological exploration that we are doing. We announced that we spent 4.5 million last year on geological exploration. That was funded from internal resources. I would think the figure this year would be roughly the same, and again, that would all be funded from cash that we're generating. So I think the low cost gives us enough cash generating ability to be able to fund everything that we want to do in terms of the geological work, the firming up of the resources. And obviously, if a project was to come along that we wanted to invest in, say we discover a new ore body out of the helicopter survey, we've either got our own funds to do that, or we've got very good access to bank finance. So, I mean, obviously, having such a low cost gives us the flexibility to do these things, given that we can generate the cash. I mean, a lot of gold miners who've got a all-in sustaining cost of $1,000 are, you know, really working hard, really just to stand still, where we don't have that. It gives us the flexibility to do what we want.
Thank you.
Okay, are there any other last questions in the audience? Knows the answer, so thank you very much, Bill. That was great. Let me just give you some concluding remarks. So again, you've got a pack in front of you can take with the 4-page notes on each of the companies. There's a feedback form which we would all appreciate if you could fill in. I'll remind you that those who are professional investors and are looking for a certificate for professional development, please put your name on the register outside. Date for your diary, 11th of June, Tuesday the 11th of June will be our next forum in the city. Venue to be confirmed, but companies so far are Severn Trent and Alliance Pharma. And in the coming days, you'll get electronic copies, both of the 4-page note and of the company's presentations. Thank you very much for coming along. I hope you enjoyed it, and we hope to see you at the next one.